Stock market for beginners. Are you interested in growing your savings by investing in stock? It's often intimidating to go into a new business or investment prospect, especially if you do not know much about it. But you are in luck, because in this video, we will give you an initial overview on important concepts you need to know when investing in stock market. Familiarize yourself with these terms and start working your way into next level financial literacy. Hi, welcome to RCE Finance Guide, where we will be talking about topics of handling finances and making money. We will upload videos to the channel for your watching pleasure 4 to 5 times per week. If you have any feedback or comments about the topics you would like to see, make sure to comment them down below. Also, make sure to press the subscribe button and hit the notification bell to be updated on all latest videos. If you have any further questions, you can comment on them while I worked. As mentioned, this is a mini course showing you step by step in starting to invest in the stock market. Without further ado, let's begin. Why should you invest in the stock market? First, it is historically one of the best tools to grow your wealth. The market averages 10% return of interest. Second, savers are losers. In order to battle inflation, you need to keep growing your money. Your purchasing power decreases when you keep your money stagnant. Third, it's currently pretty cheap to start investing. The norm is zero upfront charges and fees. There are also plenty of low expense ratios for a solid investment like Vanguard. Fourth, you do not have to be genius to do this. There are plenty of strategies to help grow your wealth over time. Now, let's establish terms. What is a stock? You can think of it like a slice of pizza. Buying shares of this gives you equity of ownership in the shares of a company. For example, Microsoft. They have shares of 7.56 billion. You can think of it like a sliced pizza with 7.65 billion slices. Share price is $216.02, while its market capitalization is $1.633 trillion. This is computed by multiplying the shares outstanding by the share price. Market capitalization changes over time because of the share prices and shares constantly changing also. Buying and selling a company's stock highly affects the share price. Now we ask, why do companies issue stocks? Companies issue stocks to raise money for their business for funding new products, research and development, and overall growth. There are two kinds of stock: preferred stock and common stock. Preferred stock comes with no voting rights, while common stock provides voting rights, but you're last in line to be paid out in case of liquidation. Last to get paid dividend. For beginners getting into the stock market, they typically buy common shares or stocks. Now, let's move on to how stocks are categorized. It's divided into large cap, mid cap, and small cap. Large cap usually have $10 billion plus market cap. These are the large and established companies. Mid cap usually have $2 to $10 billion market cap. Not as big as large cap, but not as small as small cap. Companies in mid cap are common target for mergers and acquisitions. Small cap have $300 million to $2 billion market cap, which are typically younger companies seeking aggressive growth. Aside from categorizing stocks into market cap sizes, it is also categorized into growth stocks, income stocks, value stocks, and stock sectors. Growth stocks have big potential for growth, but typically offer low or no dividends. Examples are Amazon, Facebook, and Microsoft. Income stocks offer regular dividend payment. These have proven track records with consistent increase in dividends. Examples are Walmart and Verizon. Value stocks are perceived to be trading below its fundamentals. These are typically seen as unfavorable in the marketplace. Stock sectors are an area of the economy in which businesses share a product or service. There are 11 broad sectors, and these are energy materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, utilities, and real estate. So far, we have covered some important terms that you need to familiarize yourself within investing in stocks. Are there any concepts that are not clear and you would like to be discussed further? Please tell us in the comments section below. Also, if you like this video, please give it a thumbs up. Now, we move on to the concept of risk. Risk is the chance that your actual income will differ from your expected outcome. Risk includes the chance of losing some or all of your investment. As investors, we are compensated for the level of risk we assume. It's the same way that investing in a startup is a bigger risk than keeping your money in a savings account. The one with high risk has more potential for growth. There are different types of risks. 1. Market risk, which is due to economic developments and other events over time. 2. Liquidity risk is when there is difficulty selling your investment when you want to cash out. 3. Concentration risk is when there are too many eggs in the basket, or you have invested too many similar stocks. Capital is concentrated too much. Number 4. Credit risk is a change that the entity you've invested in cannot pay or return your investment with interest. This happens when a company falls into bankruptcy. 5. Inflation risk. It is the loss of purchasing power. 6. Horizon risk is a change in your investment timeframe. Example is when you are committed to investing for 10 years, but you suddenly need the money only after 1 year due to unforeseen illness or large expense. 7. Foreign investment risk applies to foreign investments. Events in the foreign company and sudden economic changes will affect you greatly. Now, we understand risk and its common types. Let's talk about the types of stocks. There are 2 that we will be discussing in this video: individual stocks and mutual funds. Individual stocks, common and preferred stocks fall under this category. These are Walmart, Netflix, Microsoft, and many more. The process of investing in an individual stocks is that there are reduced fees, no management fees. You have to complete control of what you own, and taxes are easy to manage. The con is it's hard to diversify, as you need 20 to 100 different stocks to achieve diversification. Second, it requires more effort and time to monitor the portfolio. Last, having complete control may allow you to make decisions to sell or buy based on misinformation or unwarranted emotions. Number 2, mutual funds are simply defined as pools of money from the public to buy securities. The pros in investing in mutual funds is that it's liquid, easy to buy and sell, diverse, and has professional management. And there are a lot of options like balanced mutual funds, fixed income, money markets, and many more. The cons are these have higher fees. Most of these are not FDIC insured. Large cash holdings, meaning a lot of money is kept as cash, making it vulnerable to inflation, and make it hard to evaluate or compare one mutual fund to the next. We have covered so many concepts and important information today. If you have any questions and clarifications about the topic we have covered so far, just ask in the comments section below. In our next video, we will cover the other types of stocks or equities such as index funds, exchange traded funds ETFs, and REITs. We will be also telling you more useful information to prepare you for the stock market. As always, please do not forget to like, subscribe, and turn on notification so that you will be notified when we drop our next video. Take care.